Are you interested in investing in a company or just want to understand how a business operates financially? If so, understanding financial statements is crucial. In this video, we'll break down the different components of financial statements, explain what they mean, and show you how to use them to evaluate a company's financial health. So grab a notebook, and let's get started. Financial statements are documents that provide detailed information about a company's business activities and financial performance. They are typically reviewed by government agencies, accountants, and firms to ensure that they are accurate and useful for purposes such as taxes, financing, or investing. If you are considering investing in a company, it is essential to examine the financial statements to determine the company's financial health. The company's financial statements can be found in its annual report, which can be easily accessed on the SEC filing website. According to Warren Buffett, it is crucial to think like a business owner when investing in companies. Therefore, it is essential to check the company's financial well-being before buying any ownership through stocks. The financial statement is basically a report card for a company, and it has three main parts: the income statement, the balance sheet, and the statement of cash flow. The income statement gives you an idea of what the company is up to, with details about its sales, expenses, and earnings. Meanwhile, the balance sheet shows you what the company owns and owes to others, like debtors and shareholders. These are called assets, liabilities, and equity, respectively. The statement of cash flow tells you how money is moving in and out of the company, which is super important because making money is what business is all about. It's key to understand all three parts of the financial statement if you really want to get a handle on a company's financial health. By studying the income statement, balance sheet, and statement of cash flow, you'll be able to see how the company is doing and make smart investment decisions. The income statement is a really useful tool to help understand a company's financial performance. The income statement shows the revenue and expenses of the company over a certain period of time, usually a year. The revenue is the income that the company earns from selling goods or services to customers, and it's recorded as the top line. On the other hand, net profit is the bottom line, which is the amount of money that a company earns after deducting all of its expenses from its total revenue. When analyzing the income statement, a good place to start is by looking at whether the company's revenue and net profit are increasing annually. If they are, it could be a sign that the company is growing by attracting new customers or having existing ones buy more of its products or services. A company with increasing revenue and net profit is generally considered to be financially healthy, and it could be a great investment opportunity. But keep in mind that a company's revenue and net profit may not always increase every year. Sometimes, a company may have already dominated the market, so its revenue may be stable. In this case, a company with stable revenue and net profit may still be financially healthy. On the other hand, a company with decreasing revenue and net profit is a red flag and could be a sign of financial trouble, so it may not be a good investment opportunity. So, analyzing the income statement can help investors and analysts make informed investment decisions. By examining the company's revenue and net profit, you can determine whether a company is growing, stable, or in decline. This can help you make informed investment decisions accordingly. Two important metrics to consider when evaluating a company's financial health are the gross margin and net margin. The gross margin tells you how much profit a company makes after accounting for the cost of producing its goods or services. It's calculated by subtracting the cost of goods sold from the revenue, which gives you the gross profit, and then dividing this by the revenue. A higher gross margin means that the company is more profitable and has more money to cover its other expenses. Personally, I like to find companies with a gross margin of more than 40% so I know the company has a good competitive advantage. The net margin, on the other hand, tells you how much profit a company makes after all of its expenses are accounted for, including taxes and interest. It's calculated by dividing the net income by the revenue. A higher net margin means that the company is more efficient at managing its costs and generating profit. Usually, I would prefer a company with a net margin of more than 15%. Of course, there are many other important financial metrics to consider when evaluating a company's health, and we will explore those in future videos. But for now, understanding these two margins can give you a good starting point for assessing a company's financial performance. Moving on to the balance sheet, one important financial metric I like to check is the company's debt-to-equity ratio. This ratio can tell you a lot about the company's financial health. The debt-to-equity ratio measures how much a company relies on debt versus equity to finance its operations. A higher DE ratio indicates that the company is using more debt to finance its growth, while a lower D/E ratio indicates that the company is relying more on equity financing. To calculate the D/E ratio, you first need to determine the total amount of debt, which is also known as total liabilities. Next, you need to determine the total amount of shareholders' equity. Once you have those two numbers, you can simply divide the total debt by the shareholders' equity to get the D/E ratio. Why is this important? A high D/E ratio can make a company more vulnerable to economic downturns, as it may struggle to make its debt payments. On the other hand, a low D/E ratio can indicate a company that's in a strong financial position, with more flexibility to weather economic storms. It's worth noting that the optimal D/E ratio can vary depending on the industry and the company's specific circumstances. Therefore, when evaluating a company, it's important to compare its D/E ratio to that of its peers and consider other factors such as growth potential and cash flow. If you're just starting out with investing, a good tip is to look for companies with a D/E ratio of less than 1. This means the company has more equity than debt, which is generally considered a good thing. Another important metric to consider is the current ratio. The current ratio is a measure of a company's ability to pay off its short-term liabilities using its short-term assets. To calculate the current ratio, you simply divide the company's current assets by its current liabilities. Generally speaking, a current ratio of 1 or higher is considered to be good, as it indicates that the company has enough current assets to cover its current liabilities. However, keep in mind that the optimal current ratio can vary depending on the industry and the company's specific circumstances. For example, a company in a capital-intensive industry may require a higher current ratio to maintain its operations. Understanding the current ratio is a good starting point for assessing a company's ability to meet its short-term obligations. In the statement of cash flow, one important financial metric to consider when evaluating a company's health is free cash flow. Free cash flow is the amount of cash a company generates after accounting for all its expenses, including capital expenditures. This metric is important because it indicates whether a company has enough cash to pay for its ongoing expenses, invest in growth opportunities, and distribute dividends or buy back stock. Companies with positive free cash flow have more financial flexibility and may be more attractive to investors. To calculate free cash flow, you need to take a company's operating cash flow and subtract its capital expenditures. Capital expenditures are the expenses that a company incurs when it buys or upgrades its long-term assets, such as land, buildings, or equipment. While these are important investments for a company to make, they can also be costly. Subtracting capital expenditures from operating cash flow can help you get a better sense of a company's financial health. By the way, if you're examining a company's statement of cash flows, you might notice capital expenditures listed as purchase of property, plant and equipment. It's essentially another way of describing the same thing. Keep in mind that there is no one-size-fits-all number for free cash flow, as it can vary depending on the industry and the company's specific circumstances. To simplify things, just look for companies that are producing positive and increasing free cash flow. Thanks for watching our video on financial statement analysis. We hope you found it helpful and informative. If you want to learn more about the different metrics and ratios, make sure to subscribe to our channel and hit the bell icon to get notified for future videos. If you enjoyed this video and found it useful, please give us a thumbs up. And if you have any suggestions for future topics, please leave a comment below. Remember, financial statement analysis is just one piece of the puzzle when it comes to evaluating a company. It's important to consider other factors like industry trends, management quality, and competitive positioning as well. By regularly assessing a company's performance and financial health, you can make informed decisions and invest in great companies that have the potential for long-term growth. When a company is performing well and generating profits for its shareholders, you can rest easy knowing that your investment is in good hands, even if the stock market is experiencing fluctuations. Remember, the key is to focus on the long-term health of the company rather than getting caught up in short-term market trends. Thanks again for watching, and we can't wait to bring you more valuable insights in the future. Happy investing!